Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Cisco.
If you find our talks useful, please consider subscribe, like, and comment underneath.
And real quick, before we jump into the analysis, you can find the VIP Algos link below in the description.
Yeah, it's an amazing tool for tracking institutional money flow and all those hidden market signals. So definitely check the VIP Algos link down there.
Absolutely. So let's get into it.
Right. So if you look at the greatest wealth generation over the last, 2 years of this whole artificial intelligence boom, you were probably looking at the chip makers.
Oh, for sure. The companies making those incredibly complex processors.
Exactly. Or the organizations building the massive data models. I mean, we treat the chips like the brain of the operation. But what if the next massive bottleneck, the real choke point of the AI revolution, isn't the brain at all, but the nervous system?
See, that is the critical distinction the market is waking up to right now. I mean, what's fascinating here is that you can have the most powerful AI in the world sitting in a data center, but if you can't move unimaginable amounts of data from point A to point B instantly, the whole thing just breaks.
The entire system grinds to a halt.
Exactly. The physical reality of networking becomes the ultimate constraint.
Which brings us to the core mission of our talk today. We are unpacking Cisco's Q3 fiscal year 2026 earnings report alongside some really major analyst notes from Morgan Stanley and HSBC.
Yeah, and we're looking at how a company that so many people had written off as just a sleepy, conservative dividend stock is aggressively weaponizing billions of dollars. They're trying to corner the AI infrastructure market.
And if you've been feeling like you completely missed the boat on the primary AI boom with the chip makers, this is the context you need. This is the massive secondary picks and shovels wave.
Right, because historically, if you held Cisco in a portfolio, you held it for stability.
Yeah.
It was legacy hardware.
A very safe, boring dividend play.
Exactly. The broader narrative on Wall Street was that physical hardware was basically a dying business model. Everything was transitioning invisibly to the cloud and software.
But the cloud still relies on physical servers.
Yeah, and those servers require physical cables and routers and switches just to communicate.
To put the sheer scale of this pivot into perspective, we only need to look at two numbers from this recent earnings report. First, they raised their fiscal 26 AI order target to $9 billion.
$9 billion. That's staggering.
It's massive. And second, their total revenue jumped 12% year over year. They delivered a record $15.84 billion in revenue. Plus, their non-GAAP EPS was up 10%.
So they are aggressively re-rating from a mature tech company into a high-growth AI compounder.
Okay, let's unpack this for a second. The $9 billion figure is the headline grabber, obviously.
Right, because it validates their ability to sell directly to hyperscalers.
Yeah.
The massive tech giants building out the world's largest data centers. Their hyperscaler AI orders alone surged to $5.3 billion year to date.
But focusing solely on those mega corporations kind of misses the deeper shift, doesn't it?
It absolutely does. The truly revealing metric in all this research is that Cisco's product orders, excluding those massive hyperscalers, grew by 19%.
Wait, 19% just from everyday enterprise customers?
Yep. Nearly 20% growth coming from outside the handful of companies that dominate the AI headlines.
That tells me this isn't just a temporary spending spree by 3 or 4 tech giants fighting a turf war.
It proves the demand is incredibly broad-based. What we are seeing in the data is a massive global enterprise refresh cycle.
Because their core networking revenue jumped 25%.
Right, exactly. Data center switching was up over 40%. But perhaps most tellingly, campus networking grew by over 25% too.
And campus networking, that's like the infrastructure running everyday corporate offices, universities, hospitals, stuff like that.
Yeah, the everyday places we all work and visit.
Let's ground that in reality for the listener. Think about the Wi-Fi in your office or a local hospital right now. We all know the frustration of a network that struggles to handle a simple video call without buffering.
Right, we've all been there with a spinning wheel.
Exactly. Now imagine if that same hospital network suddenly has to support hundreds of autonomous, real-time AI agents that are analyzing patient data, updating records, and cross-referencing global databases simultaneously.
The legacy hardware would simply collapse under that weight.
Mm-hmm.
The latency would completely destroy the utility of the application.
Okay, define latency for us in this context.
Latency is basically just the delay before a transfer of data begins following an instruction.
So the lag.
Right. If you are asking a generative AI to, write a poem, A 2-second delay is fine. You don't really care.
Sure.
But if an AI agent is monitoring a live surgical feed or managing the energy load of a city's power grid, a 2-second delay is catastrophic.
Wow, yeah, when you put it that way, everyday enterprises really have no choice. They have to overhaul their internal networks to survive an AI-driven future.
They absolutely do. But recognizing you need an upgrade is one thing. Deciding to spend a premium on Cisco instead of cheaper alternatives is another entirely.
Right, because there are plenty of companies manufacturing networking equipment using generic off-the-shelf silicon, right? The industry calls it merchant silicon.
Exactly. So why are hospitals and universities and tech giants choosing the more expensive Cisco route?
Well, it comes down to a structural moat, right? A very deliberate, long-term strategic bet they made.
Yeah, Cisco's CEO, Chuck Robbins, actually noted in the earnings call that without their proprietary architecture, which they call Silicon One, that $9 billion AI order book would likely be close to zero.
Zero. That's quite the statement.
It really is. They made the painful decision years ago to design their own silicon from the ground up, rather than buying generic chips.
Here's where it gets really interesting because I want to break down why that proprietary silicon matters so much. The mechanics here are fascinating.
Go for it.
To use a car analogy, old networking architecture operates a bit like bolting anti-lock brakes onto a car as an afterthought.
Nah.
You hit the pedal, a signal goes to an external computer, it thinks about it, and then sends a signal back to the wheels. It takes time.
Right, there's that latency again.
Exactly. But Cisco Silicon One is designed more like having the anti-lock brakes built directly into the engine's core computer. The intelligence and the security are built directly into the local network node. It reacts instantly without needing to take a detour.
And that structural integration is the key to surviving what we call agentic AI.
Agentic AI. We're hearing that term a lot lately.
Yeah, because early AI was passive, right? You asked the chatbot a question and it generated text. Agentic AI actually takes actions across multiple platforms on your behalf.
So give me an example of what that looks like in the real world.
Imagine an AI supply chain agent that detects a storm in the Pacific. It instantly contacts 3 different shipping vendors, reroutes $1 billion in cargo, and recalculates the quarterly financial projections across the company's accounting software.
All on its own.
All on its own and all in like 50 milliseconds.
But to do that securely under the old model, the network switch would have to take that packet of data, physically route it out to an external firewall, wait for it to be inspected, and then receive it back.
Right, and in an agentic AI world, you simply cannot afford the milliseconds it takes to make that detour.
So Cisco builds their own Silicon One chips to manufacture these smart switches.
Exactly. They embed the security services directly into the microscopic architecture of the network switch itself. So they run these security protocols at what the industry terms line speed.
Meaning the data packet is inspected for threats at the exact same physical speed the wire is carrying it. No detours, no external firewalls.
It just flows.
Yeah.
And that creates a unique performance gap that is almost impossible for competitors to close.
Because pure-play networking companies don't have the integrated security division.
Right. And pure-play cybersecurity firms don't manufacture the physical networking chips. Cisco has both.
And they've announced that by fiscal year 2029, every single high-end system they sell will run exclusively on this Silicon One architecture.
So they are effectively boxing out the competition that relies on that generic merchant silicon.
And once a massive enterprise rips out its old wiring and installs this new Cisco architecture, they aren't going to switch providers a year later.
No, it's way too disruptive. The switching cost moat is massive. Analysts estimate there is a $100 billion to $200 billion end-of-life equipment refresh opportunity unfolding globally.
And we are only in the very early innings of it.
We are. But designing a revolutionary chip on a whiteboard and getting billions in orders is entirely different from actually delivering millions of physical boxes.
Right. You need the raw materials. You need the supply chain.
And right now, the global AI supply chain is severely constrained. Everyone is fighting for the exact same specialized memory components.
Which shifts our focus to how Cisco is operating behind the scenes. This is where their history as a massive cash-generating legacy business suddenly becomes a huge advantage.
A fortress balance sheet. They generated $3.34 billion in free cash flow in the third quarter alone.
And they're projecting $4.7 billion for Q4.
Right.
Exactly. Free cash flow of that magnitude allows a management team to play a completely different game than a startup. They don't have to borrow at high interest rates to secure materials.
So what does this all mean for their operations? Because the aggressiveness here is striking. In just 90 days, Cisco increased their inventory and advanced purchase commitments by $6.7 billion.
That's a 48% increase. They essentially went out into a starving global market and bought up the supply chain.
They also locked in a strategic 3-year supply agreement with Nanya Technology. But I have to ask, isn't tying up nearly $7 billion in cash for inventory incredibly risky?
It sounds like it, yeah. I mean, if the AI hardware market suddenly cools down, aren't they just left holding billions and depreciating physical boxes?
It carries risk, certainly. But if we connect this to the bigger picture, you have to view it through the lens of supply assurance. They are weaponizing their balance sheet to guarantee their own pipeline.
Oh, I see. So if you are a hyperscaler trying to build a data center today, your biggest fear isn't the price of the router.
Exactly. Your biggest fear is that the router won't arrive on time, which delays your billion-dollar AI model.
So by hoarding those components, Cisco is buying certainty for their clients.
They are looking at the market and saying, we have the cash to guarantee we will hit that $9 billion order target. Smaller competitors might promise a cheaper switch, but they can't guarantee they'll have the memory chips to build it.
That completely changes the purchasing calculus for the buyer. And remarkably, even while deploying that massive amount of capital, Cisco is still returning 50% of its free cash flow to shareholders via dividends and buybacks.
It's a massive flex of financial muscle.
So we have this broad-based enterprise growth story, a proprietary technological moat, and a fiercely defended supply chain. How is Wall Street actually pricing this transformation?
The stock chart reflects a market that is really buying into this transformation. We're looking at a huge technical breakout. Over the past year, the stock is up roughly 85%.
85% for Cisco, that's not something you see every day.
Not at all. Year to date, it is up 58%. It's been trading in that $121 to $122 range, sitting just shy of its all-time high of $130.37.
And reading through these analyst notes, Wall Street is highly bullish. Morgan Stanley raised their price target to $130, specifically citing the explosion in inference workloads.
Yeah, and HSBC went even further. They upgraded them to a buy rating and pushed their target to $137.
So the overarching sentiment has shifted from deep skepticism to a belief that Cisco is staring down a multi-year runway of unconstrained demand.
That's the consensus, yeah.
But if the story is this bulletproof, I have to point out a glaring contradiction in the data. There was coordinated selling of the stock by the C-suite executives between $114 and $120.
Ah, the insider selling.
Yeah. If the people running the company, the ones who see the internal data every day, are dumping their shares, my immediate thought is that the top is already in.
It's entirely logical to view insider selling as a red flag, for sure.
Right. Like, they know the growth is maxed out and they're cashing out.
But we have to look at the mechanics of executive compensation here. Think about the timeline. Cisco stock sat relatively flat for years.
Very true.
So the executives holding stock options essentially had stagnant assets. Then suddenly, the stock goes on an 85% run in a single 12-month period.
Oh, so their personal net worth would become dangerously concentrated in a single asset overnight?
Exactly. It violates every rule of financial planning. What the market flow data shows isn't a panicked exit. It is standard, programmatic portfolio diversification.
They are just monetizing a sudden windfall.
Right. And more importantly, if you look at who's buying the shares the executives are selling, it's a massive institutional accumulation.
Okay, so mutual funds and pension funds are absorbing those shares. That explains why the stock price hasn't collapsed under the weight of the insider selling.
Exactly. But, no company is immune to gravity. To fully understand this pivot, we do have to look at the bear case.
We do. Because there is a very real friction point in this Q3 report that threatens to derail their momentum, and that is the margin squeeze.
The margin compression is without a doubt the single most vulnerable part of Cisco's current narrative.
Their non-GAAP product gross margins dropped by over 3% or 330 basis points down to 64.3% for the quarter.
Yeah, that's a significant drop.
To the average observer, this makes no sense. Wait, they are selling record-breaking volumes of product but making less profit per box. How does scaling up result in making less money per unit?
It comes down to the mix shift toward expensive AI hardware, and specifically the macroeconomic cost of materials.
The memory chips.
Right. To process these massive AI data packets without latency, these new network switches require incredibly large specialized memory buffers. You literally have to pack more physical memory chips into every single box.
And the global cost of those memory chips has skyrocketed because everyone is trying to buy them.
Exactly. So they are selling far more of these highly complex, memory-heavy AI boxes, which cost more to build. It drags down the overall profitability average.
Management is acutely aware of this, though. They have instituted over 20 different memory reduction programs.
And the most critical shift is their transition from the older DDR4 memory architecture to the newer DDR5 standard.
Okay, explain how swapping a memory standard actually fixes a profit margin issue.
DDR5 processes data significantly faster and has a much higher bandwidth capacity than the older generation, and it consumes less power.
So it's vastly more efficient.
Right. Which means Cisco's engineers can achieve that same ultra-low latency using fewer physical memory chips per router.
Fewer chips mean lower manufacturing costs, which directly repairs the profit margin.
Exactly. Plus, they are simply raising the prices on their customers. About 4 to 5 points of that massive Q3X hyperscaler growth was driven purely by price hikes.
Lee, really? Just from price hikes?
Yeah, not volume, just price increases. Through these combined efforts, management is targeting a bounce back to a 66% profit margin.
But they still have to prove to Wall Street that these fixes work in the real world? Which brings us to the valuation risk. Right now, investors are paying a premium.
A huge premium. It's trading at a forward PE ratio of 26x.
Meaning the market is paying $26 today for every $1 of profit they expect Cisco to make next year. The stock is priced for perfection.
It is. If that enterprise growth suddenly slows down, that premium could vanish overnight, and the market's tolerance for that valuation will be tested immediately.
The ultimate catalyst, August 12th, 2026. Their Q4 earnings.
The crucible for this entire narrative.
What specific numbers does Wall Street need to see on August 12th?
First, they need to see roughly $3.7 billion in new AI orders for the fourth quarter, just to mathematically validate that $9 billion target they've promised for the year.
But the market is forward-looking.
Right, so Wall Street also wants formal guidance for fiscal year 2027. They need management to confidently guide for at least $6 billion in AI revenue for the following 12 months.
And August is also when we get to see if those engineering fixes are working. They are rolling out a new line of memory-optimized wireless products in Q4 that require 50% less memory to manufacture.
That's the litmus test. Can they maintain massive sales volume while fundamentally lowering the hardware cost?
If customer adoption is strong and margins trend back towards 66%, they prove they can navigate the costs of this transition.
But if margins continue to bleed, the market will severely punish that 26 times valuation premium.
So bringing all these threads together for our final verdict, what we are witnessing is the real-time evolution of a legacy giant. Cisco has aggressively broken out of the mold of a slow-growth dividend stock. We're looking at a solid 8 out of 10 bullish score here.
I agree with that 8 out of 10. Between their Silicon One moat, their massive enterprise refresh cycle, and their ability to strong-arm the supply chain, they are positioned for a multi-year run.
Assuming they can navigate the margin squeeze and deliver on their upcoming August earnings, it's a profound example of an incumbent tech company using its massive financial scale to force its way into the future.
It really is.
Which leaves us with a final, provocative thought regarding our long-term view. As the AI industry shifts globally from training large language models in isolated data centers to everyday inference workloads out in the real world.
The era of agentic AI.
Exactly. As that reality takes hold, the ultimate bottleneck will no longer be raw computing power. The true bottleneck will be the physical ability to move that intelligence safely, securely, and with zero latency.
So in a fully realized agentic AI future,
will the companies that control and secure the network itself ultimately hold more leverage over the economy than the companies that merely manufacture the chips?
it completely reframes how you look at the infrastructure quietly humming away in your office ceiling.
It really does. Thank you for joining us on this analysis. Please remember to subscribe, like, and comment underneath.
And remember to grab that VIP Algos link down in the description. It's essential for tracking these kinds of massive institutional shifts.
Keep questioning the infrastructure around you, and we will catch you next time.